Philipp Hildebrand was the head of the chair of the Swiss National Bank, the central bank, now vice chair at Blackrock. He joins me from Switzerland. Good to see you, Philipp. Should the ECB be moving sooner and harder than they are? Are they not storing up exactly the same transitory mistake made by the FOMC?
Richard, I think it's very important to distinguish between the kind of two phases of monetary policy. What's going on here is we're in a restart. This restart no longer requires emergency stimulus, and so central banks should begin to take the stimulus off, take the foot off the accelerator. That's what they're doing. That's what they're signaling. That's what we're seeing either in speeches or in actual rate decisions, as in the case of the Bank of England. And I think that's entirely appropriate. It's a whole different story what you're pointing to, should they hit the brakes? And I think the answer there is no, simply because this inflation, this uncomfortably high inflation, is principally supply side driven. It's a result of bottlenecks that are related to the restart. And you would have to hit the brakes very, very hard to get inflation down. So there are two different things going on here. Normalization, yes. Hitting the brakes, I think that's a long way off for the time being, because it will not be the right answer to get the inflation rates down.
But if you look at what the BOE decided today, and yeah, certainly the BOE did a 5-4 with the minority wanting half a percentage point, but they also completely changed, if you will, the repurchases, no more repurchases, the running down of mortgage-backed securities, the sale of them. Now, I know that there are monetary technical plumbing issues in doing all of that, but I wonder how far the ECB risks being behind the curve, because inflationary expectations are high.
Well, in the case of Europe, inflation expectations, long-term inflations inflation expectations are pretty well anchored. So they're not in a particular rush to hit the brakes. Everything we've seen so far is about taking the foot off the accelerator. It's not about hitting the brakes. It's about taking away the emergency stimulus that is no longer required. What's challenging for the central banks here is they know that this inflation is principally bottleneck driven on the supply side. They also know that interest rates is not really going to take care of that. So what they have to be careful about is not to confuse the market about sort of saying we're normalizing and at the same time letting the market believe suddenly, inadvertently, that they're getting ready to really hit the brakes hard. And I think that's what we're seeing. So I would expect the market to be confused for some time until the central banks become very clear. We should expect some volatility here. But ultimately, I continue to believe that this rate cycle, Richard, and you alluded to it earlier, will be much more muted than what we would normally see in this kind of environment. And the reason is that it doesn't really address just raising rates. Hitting the brakes here will not address these bottlenecks that are caused by the restart, that are the underlying cause of the higher inflation.
How concerned should the Fed be at the market dislocation that we're currently seeing? Now, in the past, only on very few occasions has central banks really responded to equity markets, or certainly obviously money markets, they respond to any dislocations there. But should they be worried when the market is coming, or is this a good thing? We're seeing froth off the top.
Well, central banks, I used to do this for a living. You always think about all factors and how they affect ultimately long-term inflation expectations and how they impact output. So they're going to pay attention to these things, not from a day-to-day basis. They're not day traders. It's a different longer-term perspective. But market conditions are an important input into determining the amount of stimulus, or in this case, the amount of withdrawal that is required to get monetary policy back to neutral. So I think this is all part of an overall equation, and you take it into account. You're not driven by it from one day to the next.
I suppose people like myself are all sort of hoping you can tune it like fine-tune it like a Swiss clock or a Swiss watch when it's anything but.
Absolutely. And I think the key here is this is particularly difficult because it is the inflation we're seeing, Richard, is not the result of an overheating economy. It is the result of these bottlenecks that are related to the restart. So the best thing we can all do is to open up the economies, of course, we need to consider the health implications, but that will ease the inflation pressure, and that's the right response here, not simply to hit the brakes. But for now, all we're seeing is the beginning of normalizing policy, taking away this emergency stimulus. We're seeing some tough talking that's creating the confusion, but in terms of action, it's about withdrawing stimulus, taking the foot off the accelerator.
Philip, it's good to see you, sir. I wish you well. Thank you for joining us. I appreciate it. Thank you.